This cassette comes to you a bare month after what's become known in market history as Black Monday. No one pretends it's an easy time. It manifestly isn't. But Gartmore are taking a medium to long-term view of the prospects. After all, in buying unit trusts, no one is looking for immediate results. So, in the next 15 minutes or so, you'll be hearing from the Gartmore team about where they see the market going and just why it's worth staying in there. If you doubt that proposition, listen to Peter Pearson-Lund, Managing Director of Gartmore Fund Managers, look back briefly at the recent history.
If you look at the 5- and 3-year figures, even allowing for the falls in markets, the results are very pleasing. You're considerably better off investing in unit trusts than you would have been in building societies or money on deposit, even over relatively short periods of time. So the unit trust has done its job, even allowing for all that's happened.
Peter Pearson-Lund, from whom you'll be hearing a little more later. But you're probably wondering by now, who isn't, about just how the markets collapsed so suddenly. Speculation, amounting to fact, now concentrates on the United States federal budget deficit. In a sense, that isn't surprising. Experts have been warning about it for the past several years. But what is surprising is the suddenness with which the bearish factors it implies have hit the markets. So, where do we go from here? Peter Scott is the International Investment Director of Gartmore Fund Managers, and in a moment he'll be answering that question. But first he gives an analysis, so far almost ignored, of why we're just where we are.
One very clear fact is now emerging, and that is that a large part of the decline in the US market, which initially set off the decline in other world markets, was attributable to withdrawal of overseas investment, and in particular by Japanese investing institutions who turned from being very large supporters of the US securities markets, particularly the debt market, into being net sellers of the US markets in the second half of October.
The Japanese institutions have got a long and deserved record for moving cautiously. In the light of what you've just said, can we now expect it to be some considerable time before the markets turn round again?
Well, I think it's going to take some considerable time for the markets to regain their confidence. My view is that there will be some positive, strong action, but that it's going to be a little bit disappointing to the financial markets. And I think it's possible that there will have to be more pressure put on the US authorities to find a solution.
And what about third world debt? Progress did appear to be on the horizon, now perhaps receding again?
Well, I think that's right. The normal rule of thumb that bankers have been using is that the world economy has to grow by some 3% per annum to allow the developing countries enough leeway to export themselves out of trouble and pay the interest on their outstanding debt. That seems pretty unlikely now, so I think we are going to get further aftershocks in the form of debt defaults at some juncture, yes.
There is a brighter side to the picture. Let's turn to it. We've already seen interest rates in the stronger currency countries coming down. Prospects there of more to come, would you say?
Yes, the good news is that interest rates will come down quite dramatically, and I think probably by more than people expect at the moment. Just in the same way that the equity markets will overshoot downwards, I think interest rates are likely to overshoot downwards as well, and that's probably what will herald the turning point in equity markets. Of course, it's already leading to a very strong upward move in fixed interest markets, where for the first time in a number of years you can actually make real profits by investing in the fixed interest area.
What have you got to say about the equation which some people certainly believe in? Cheaper money means higher inflation.
Well, I think that's simply not true. I mean, all the evidence at the moment is that world commodity prices are sagging and will continue to move lower. That really is going to take the pressure out of inflation. And I think the estimates that we're seeing on inflation at the moment are almost certainly too pessimistic.
Peter, finally, and to revert to your point about the fixed interest markets, as you say, looking strong, could they be a forerunner, a leading indicator, if you like, of a return to sound and solid booming equity markets?
Well, fixed interest markets normally lead equity markets by a period of between 3 and 9 months. In fact, they turned down some 6 months before the equity market crash occurred. And I think it's highly likely that with fixed interest markets strong now, they will indeed be a precursor to stronger equity markets at some point in the next few months. Timing is very difficult, but the whole process has been collapsed into such a short period that it may be that the bottoming out and the upturn will happen more quickly than people expect as well.
Peter Scott. One very clear element in recent events was the extraordinarily rapid change from a bull to a bear market. I spoke to Martin Page, a director of Gartmore Investment Management Limited, who's responsible for investment trust funds. I asked him exactly where we are now.
Normally at the peak of a bull market we see greed. In the middle of either a bull market or a traditional bear market we often see sense. And at the bottom of a bear market, or near the bottom, we see fear leading to panic. And at the moment I think we're into the fear stage. I'm not yet convinced we're into the panic stage.
Can we look at the previous collapse, the one that people always mention now, not 1929 but 1974? Is it very different now?
There are significant differences between now and 1974. First of all, at that time we had high and rising inflation. Secondly, we had a Labour government, and there was a feeling in the investment community that there was a lack of sympathy from that government. I think that's one of the major things, and it was not just in Britain alone. There was a considerable socialism, as it were, right across Europe, and we've seen a large political trend to the right, and I don't really think that is going to change just because of this crash. So I think those are some fundamental differences. Furthermore, companies in 1974 were strapped for cash. Generally, and certainly in the UK, they are not strapped for cash at the moment.
Not a cash problem then, but nevertheless, after a fairly long period of investors spreading their wings around the markets of the world, we could now be seeing the first signs of a retreat to the more familiar home territory. Reverse globalization. Understandable, yes, but is it wise?
There does seem to be the beginnings of a tendency of people to go back home, and quite what the logical reason for it is, I'm not sure. It seems to be some sort of gut human instinct, but I think one of the effects of it has been to speed up the fall, because first of all we have instant global communications, and that was in a way what drove the globalization in the first place, and now that seems to be reversing itself, and I think the consequence is that it's speeding up the fall.
Can we now talk about some of the companies that, whatever happens, seem to grow and prosper? Are we in a position at the moment to pick out exactly which ones they are?
I don't think we're in a position to pick out those companies yet. Once the market has bottomed, and it may then be into a long period of nothingness, as it were, for want of a better expression, then gradually it does become obvious that certain companies are going to continue growing whilst others may be growing less fast than originally expected, or indeed slowing down, and it's up to alert fund managers to then pick those stocks. If there were another fall in Wall Street, then I do think it would be so serious that politicians would be forced to bury their differences and really sort out the problem. I don't think we're there yet.
Martin Page. So far we've been hearing a lot about the equities markets, understandably, but what about the fixed interest markets? Have they gone all that quiet too? In fact, no, they haven't. On the side, they've actually been doing rather well. For a more precise view, we turned to the fixed interest manager at Gartmore, John Presland.
In contrast to equities, fixed interest markets in almost every country in the world have put in a very strong performance since the equity crash began. We've seen investors begin to transfer out of equities into fixed interest, but we have also seen generally interest rates coming down, and that has of course included the returns on fixed interest securities.
So are we really saying then that fixed interest markets, and perhaps British government securities in particular, are a safe haven in times of turbulence on the equities markets?
There's always been a case for investors having fixed interest securities in their portfolios precisely for safety. But what we have been saying is that they, rather than simply holding their value, fixed interest securities have been gaining in value quite markedly. UK government securities are up by more than 10% since the equity crash began. And we do think there are further gains to be made. So we can now say that our fixed interest funds are not just income funds, they are also offering investors the possibility of capital gains.
Does the corollary, though, not also hold true that when equities bounce back sooner or later, that the fixed interest markets will then lose their luster?
We've seen in the recent years what people have spoken about as a cult of the equity, when people have ignored investments in other sectors. One of the lessons of the crash has been that equities are a risk investment. And we expect, and it's certainly going to be the case with institutional investors, we expect investors to maintain a higher proportion of fixed interest securities in their portfolios in the future. So we do see the long-term demand for such investments being higher than it has been during the past few years.
So, fixed interest markets have retained their strength. In that case, of course, the question arises of how investors can benefit.
Well, what's on offer is a level of income which is considerably above that available on any equity investments. Gartmore's International Fixed Interest Trust, for instance, currently yields well above 9%. But this is accompanied by the prospect of capital growth. The funds have been rising in value since Black Monday, and we expect them to continue to do so.
John Presland. It must be said that at times of severe downturn, markets are often viewed simply in terms of fear or greed. But realistically, is this still true, or are perhaps the fundamentals re-exerting themselves? A director of Gartmore Fund Managers Limited, responsible for UK investment, is Graham Jobling.
I believe in the medium term, investors will come back, both in the UK and in overseas markets, to look at where the real value is around the world. And to my mind, there is very good value in the UK at the current moment of time.
When investors do come back into the market, as you've just been suggesting, will they again be motivated on emotional factors, in this case greed, or will they, in this instance at least, be looking more at the fundamentals?
No, in this instance, on a recovery, they're much more likely to look at the fundamentals. We'll be looking to domestic companies for the initial upturn in the markets in the UK, although it must always be borne in mind that the major sufferers during this bear market downturn have in fact been the overseas earners and those with a particularly high proportion of their earnings from the States. When we come back to equilibrium in the UK market, one will be able to do one's figures a bit more accurately. And I'm not saying that one would steer clear of all overseas earners. We have to look at the fundamentals as they stand when things settle down.
Graham, you of all people least need to be told that there has been a very great deal of melodramatic comment about the stock market crash. What you're really now saying, though, is that one can plausibly, genuinely and honestly see more than a glimmer of light in the future. One can, in a restricted sense at any rate, see an optimistic scenario as we move into 1988.
Yes, I think that's right. The message that we're trying to get across on the UK side is that there is very good fundamental value around in the market. Certainly for the new investor that's not involved in the stock market, my recommendation to them would be to put a little bit in now, and on any further falls in the UK market, continue to put a bit in on falling markets, because there is underlying fundamental value there.
Graham Jobling. Maybe you're thinking some of this sounds a trifle abstract. In one sense it is, but in another it isn't. Let's bring those two themes together by saying you may quite possibly not have all that much money available, and perhaps little or none at all to invest in new ideas or ventures. David Piper, Marketing Director of Gartmore, is ideally placed to understand that, or similar points of view. He recently spent all 4 days on the Gartmore stand at the Money 87 exhibition at Olympia in London. He and the rest of the Gartmore team talked to a wide range of visitors, including scores of private investors. What were David's impressions?
Everyone I spoke to, and at times we had nearly 20 people on the stand, all actively talking to both their own investors and investors from other companies. They weren't irate, but they were concerned what to do for the future. They were looking for opportunities to buy. We were trying to dissuade them from that, because our view at the moment is that people should be watching the press for views and speaking to their advisors, and in turn speaking to us. Our investor services department and our shop are there for that very purpose, so that they can communicate on a regular basis with us and find out what's happening as it happens.
David Piper. Away from the markets themselves for a moment, Gartmore, as you probably know, has recently acquired the Oppenheimer Group, itself a considerable force in the market. We thought you might be interested to hear how that acquisition is bedding down within the Gartmore Group. Here's Peter Pearson-Lund again.
A lot has been happening behind the scenes. All the investment managers have joined us. We're delighted with that. A number of the marketing people are with us, sales people, administrators, and so on. So the plan is coming together. I might just say that as part of the absorption of Oppenheimer into Gartmore, it does include Simco, the licensed deposit taker.
Now, back, but briefly, to the markets themselves. At some stage, of course, the turnaround must come. Peter Pearson-Lund's final thought is short and very much to the point.
We all know that there comes a time when the investor realises there is real value out there, and that's when the market's going to recover. So one's just got to take a slightly longer view.
And that brings us more or less to the end of this cassette. But let me just refresh your memory with Gartmore's free phone number. 0800 289 336. 0800 289 336. And at Gartmore's London head office, the Investors' Shop is now open from 8 a.m. to 7 p.m. Monday to Friday. The address is 16 to 18 Monument Street, London EC3. The nearest tube station, by the way, is Monument. And that's all from the Gartmore team. So, for the moment, goodbye.